Is the bull market for stocks back, or are we just short covering? Is $2,500 on gold still on the cards for 2022? And how important is the inversion of the yield curve for signaling recession in the US? For all this and more, I'm joined by my guest on GoldCore TV this week, Gareth Soloway of In the Money Stocks. And remember, as always, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to GoldCore TV and hit the notification bell now. And if you want to learn more about how to buy, sell, and store physical gold and silver, log on to goldcore.com, your precious metals experts. Gareth Soloway, welcome back to GoldCore TV.
Hey, thanks for having me back, Dave. Great to be here.
Now, volatility is something we have got in spades at the moment. So I'd love to just do a kind of quick whip around the markets and just get your thoughts. Last week, to begin with, in stocks, we had a very strong week for the stock markets after we saw only a 25 basis point hike from the Fed. Now, does this look like short covering to you, or is the bull market back?
So for me, it's definitely more of a short covering kind of whipsaw. Last week was options expiration. I think a lot of investors overlook that. But basically, to summarize options expiration, you have institutions selling the majority of the options to the public. And there's a specific level that they need those options, those stocks to close at to maximize their profit on those option contracts. So when they sell an option, they're getting a premium based on that sale. And that's what they're looking to pocket when the option expires. So what ends up happening is when you see a whole lot of, let's say the puts, right? Puts were betting on the downside and the market was dropping significantly. There's going to be an effort by institutions to rally the market back so that they don't have to pay out those options contracts. So I think that's part of it. I think it created a short squeeze. And I also think that the market was kind of saying, okay, we might have a little bit slightly more clarity with the Federal Reserve. I mean, it's now that we have that first rate hike under our belt, the market is now saying, okay, well, now it looks like 6 maybe entirely for 2022. We now know at least, even if that's not going to be a great thing for the economy. Now, I think it's important to understand that I don't think this rally lasts. Yeah. Number one, oil prices are sky high. I mean, we're seeing $110 a barrel again, and that's going to have a slowing impact on the market. The negative, in addition, is that high oil prices are also inflationary, right? So you have this double negative now where it's going to slow the economy, but inflation is not going to come down because of oil. And then the other side of the coin too is that historically, anytime the Fed raises rates, it slows the economy as well. So stocks are going to have to price in lower consumer demand for products, and that's going to bring down earnings estimates over the next 6 to 12 months, and markets should go lower.
So you're not confident in this bull market, this temporary bull market being sustained? And in particularly, probably looking on the charts, if you were to pull up a chart, it's probably looking very overbought short term.
Yeah, in very short term nature, it is extremely overbought. I mean, if you just look at the S&P here, the spiders, I mean, we went from 417 or 416 all the way to today's high of around 446. That is a massive 5-day move, even more so on the Qs. The Qs from the low last week, a full 10% rally to get right back to this trend line here. So on a technical basis, this is big resistance. If I zoom out, take a look at this, you actually have the low from COVID, and then this low here, we then broke below, we retraced to that same line, we broke down again, retraced to that same line again. So there certainly is technical reasons as well for why this market likely will see a pullback in the coming days, weeks, and even months.
Now, one of the things that people are very interested in this channel, as well as gold and silver, which we'll get to at the moment, is crypto. And if we look at Bitcoin, for example, Bitcoin's been fairly range bound for the last while. Is that something that you'd agree with?
Yes, unbelievably range bound. Now, a lot of technicians are starting, or a lot of investors, I shouldn't say technicians, a lot of investors are starting to get a little bit more bullish on Bitcoin because they're saying, okay, well, it's making a slightly higher high inside of this range, right? Low, higher high, and higher high. The offset is on a technical basis, that's actually not what we want to see. The bigger pattern here on Bitcoin is a sharp down move with an inside bar sideways chop. That's known as a bear flag consolidation pattern. So ultimately, whether or not we stay in this range for another month, 2 weeks, or a year even, I doubt it's a year, by the way, it's probably closer to 2 to 4 weeks. I do think that we're going to see a breakdown of this line and the next leg lower should come. And a lot of people have been saying, and this is a great little point here, a lot of people are saying, well, look over here, we were kind of the same sort of sell-off, and then we went in this sideways chop, and then we actually broke up. But the problem here is this was actually a down-sloping channel. So let me draw on these lines. They're parallel lines, down-sloping. And this one, you could argue, is an up-sloping channel here, right? So the downsloping is bullish. It's making people more bearish by making lower lows, which ultimately is bullish for price when you get the average investing public to be scared. And then over here, you're getting at the opposite. You're getting the opposite pattern, which again dictates a move to the downside. So I actually still have my $20,000 or sub $20,000 price target on Bitcoin. Likely in 2022, we should hit 20,000.
Okay, well, we'll keep an eye on that one for you. Now you touched on oil there for a second. Have you a chart on oil? Because obviously commodities have been on a severe run as of late.
Yes. So let's take a look at oil here. Bear with me as I bring it up. WTI oil, I think.
That's all right.
Well, we'll look at the USO for the time being, but basically just to surmise or summarize here, I did pull the trigger on shorting oil today. I was short on this recent move up here. I did cover my short when it got down here, and I have now re-shorted on this retrace. So I'm using Fibonacci retraces here. I'm using the concept on a fundamental basis that oil prices, the higher they go, there's more demand destruction. So people, again, I've already seen this amongst family and friends where they're not going to take that trip to see grandma 500 miles away because it's going to cost them $200, $300 just in gasoline to drive there and back. So there is demand destruction. And I think I've even heard about companies that are saying, hey, to their employees, you can actually work from home with high energy costs right now. So again, I expect demand destruction. I ultimately expect that some sort of deal will get done either with OPEC or with Venezuela or with Iran. And ultimately, I think this is a good retrace to look on the short side of oil for the next leg down. I also think that raising rates from the Federal Reserve perspective, right? If the Fed is going to continue to raise rates, that's going to have an impact on the domestic economy here, and that will also slow the consumption of oil. So ultimately, I think that these type of pops, you'll see a retrace back down, and likely I could see at some point this year $75 a barrel or lower on crude oil. So certainly a great retrace. I'm using it to short oil.
$75 a barrel. I think everybody would be very grateful at that level anyway.
Yes, for sure.
Now, one of the things that has been a hot topic of late is the yield curve, and particularly the flattening of the yield curve. And if we, kind of look at something like, say, the 2s, 10s, you've got a spread on that, the 2-year rate against the 10-year rate of just, not too far off 20 basis points at the moment. It's positive still. And most commentators would say that if that curve turns negative, if the curve inverts, that signals a recession for the US. What are the charts suggesting for you?
Yeah, so the charts are confirming that. In the bond market, they always say the bond market is kind of the biggest money out there. And so the bond market is usually the smartest money as well. And so if the bond market, if we do see, and we see the 10 and the 2-year getting closer and closer, and if it does invert, there is a history, a precedence for that signaling a recession. And if you think about it very logically, it makes a lot of sense. I mean, we're coming out of the COVID lockdown, so there is some initial spending here. But once that's done, and if oil continues to stay over $100 a barrel, and the Fed is really intent on bringing down inflation, which they kind of have to with 10% inflation here in the US, it does make sense that the economy is going to slow and there is a risk for a recession. So I think that that's something that the market, it's not really reacting in the near term here, but if you see that inversion in the yield curve, I would almost say that you will see an immediate sell-off in the stock market starting to price that in. Right now, it hasn't happened yet. Markets are kind of ignoring it, but I do think if it does happen, be ready for downside.
Okay. Are you taking a position in the bonds at the moment?
No, I haven't yet, but I am eyeing it very, very closely. What I like to trade is an ETF called the TLT, and it basically gives you that inverse relationship. And what I'm going to do is, if the TLT gets low enough, meaning yields get high enough on the 10-year, and this is kind of the way I play it, then I will look for a retrace and a pullback on yields, because I do think this is going to happen where yields on the 10-year could get to about 2.4 to 2.5%. And it's going to have such a detrimental impact on the economy, housing, investors overall, that the Fed is not likely going to be able to hike as many times as they think they can this year. Even with inflation where it is, the economy will slow down too quickly. So I will likely play for a pullback in yields off of 2.4 to 2.5% on the 10-year.
Okay. Now, the most important thing for our audience is always precious metals. Now, we've seen gold touch off an all-time high recently and have a pullback from there. Have you got a chart there that you want to pull up? Give us an idea of what you're thinking in relation to gold.
Absolutely. Absolutely. So you're right on that. And I've been talking about a gold breakout for some time. We finally got that. Now we're seeing what would be considered a classic retrace. So here's your gold chart. And again, what we did basically on the fear and panic of the Russia invasion, gold had spiked up all the way into a technical resistance level known as double top, right? So the high from 2020 basically touched in just over the last week or two. What you've now seen is a pullback in gold, and this is very common. Shouldn't make anyone bearish. This is a very healthy thing to do. This is the chart relaxing, energizing, or re-energizing itself. I think you could see gold going as low as this area here, a retrace in this range. And basically, once you get there, I will be a massive buyer of gold. I expect that this is just the beginning of a bigger breakout to the upside. And I think, again, you're heading probably this year to maybe as high as 2,500 an ounce. So there's a lot more upside to be had here. I think as we get further in the year and you start to see more and more problems develop, inflation not coming down, the economy starting to slow, maybe stagflation out there, a lot of money is going to get driven into gold. So gold looks amazingly good here. If you have a long-term horizon, buy it here, I would say. If you're looking for more of a swing trade entry like me, look for a little bit more downside, maybe to that 1850, 1840 level.
And when we're looking at the charts, we never really like to see those parabolic moves up because they tend not to be able to sustain themselves either. They get very overbought in the short term. So a retracement, a pullback is generally guaranteed when we see such parabolic moves. And we kind of want to see a little of a formation of a base there before we move a bit higher. Would you agree with that?
Yeah, I would. I think retracing to what we call the scene of the crime, which is the initial breakout area, which was right in here, that's really helpful for a chart. It makes it a stronger chart to have done that. And then you can get energy. I mean, basically when it pulls back, think about a springboard. You're pulling that rubber band more and more and more, gets here, and then it can rocket to the upside. And so I do think that that's key. I think we'll then break out above this high. And I think I've talked to you about this in past interviews, but if you look at the 1970s, when you had that high inflationary period, gold has behaved exactly like it did back then. You had the 2018 to 2020 move, which mirrored 73 to 75. You then had 2020 to 2022, which is the consolidation we saw. That was 75 to 77. And now we've started the bigger breakout, which from 77 to the early 80s, you basically, I mean, you ripped from really, I mean, I think it was around $100 and change to almost $900 an ounce back in the 70s. I don't think percentage wise, you're going to see that same sort of move because that's a massive percentage wise, but could you see 5,000 an ounce in 2 or 3 years? Yeah, I absolutely think you could.
But 2,500 an ounce, you think is potentially on the cards for 2022?
I do think this year that makes a lot of sense. If you look at measured moves in various technical charts, we have to get through this high here, which is that 2075 double top. But once that gets cleared, I think you have a lot of money that starts chasing gold up because of that breakout. That's a big, big level that a lot of investors are watching.
And finally, let's finish up with silver.
Absolutely. So silver's had a nice little short-term breakout. It's doing the same sort of retrace here. So I think we have to be aware of that as well. And I think this is the same situation as gold, where you had this breakout here. Now it's a little bit of a different chart, right? Because if you look at the gold chart, gold was basically back up to its 2020 highs. So gold was up here versus silver is only back here. But having said that, you still have seen a breakout of this downsloping trend line here. So what I think you look to do is you look to buy $24 an ounce on silver right here, and then you look for the next move up, which I do think the next move up takes us back to this 30 double top right there. So it's a nice move. I mean, $6 move, maybe in a matter of a month or two, gives us about a 25% return on silver potential for that level. And if you really want to be a disciplined silver trader, what you would do is you'd basically keep a stop on any close, right below this trend line, right? So if you're buying at 24, you're risking about $2 to make $6 on the upside. And I think that risk reward is very, very healthy.
So a price target, if we break that level, you said, 30 is on the cards again.
Yeah. So I think, again, buying 24, you see 30. Now, if it breaks 30, which eventually it will, that's tougher to know how high it could go. I don't know if you get a kind of a repetition of what we saw years and years ago of that crazy move to the upside. I think I can go to let's go to the monthly chart here. I mean, this was just absolutely remarkable. But I mean, interestingly enough, right, we could almost look at this chart and say, well, look at this. Here was your high, here and here. And then look at when it broke out. And then you could kind of make the same case where if we go to the near-term silver chart again, and let me just flip back to the daily chart, where you have the same sort of general pattern, right? Here's that high, here's that second hit. And what we're doing is we're waiting for that third hit right here. And if it can break out, do you get kind of that mega squeeze on silver that everyone is just praying for? If you've been in silver for a while, I just always, every year or two, you hear about, it's going to happen, that mega squeeze. And it might actually initiate if we get above 30.
Well, I think there'll be a lot of people who've been waiting a long time for that.
Yeah.
Silver, it tends to move more parabolic than gold, and we've seen gold obviously have that breakout recently on the geopolitical tension and war in Ukraine, and it's been really used as a safe haven. Silver has kind of followed along behind it, but hasn't had a big move on its own. And I think that if we do see that break and we see a break above 30, there'll be a lot of people who'll be a long time having been waiting for it.
Absolutely.
But, anything else that's catching your eye at the moment, Gareth?
Yeah, I mean, I think that the biggest thing that was last week for me was the Chinese stock break, surge to the upside. I mean, it got so nasty. And I always like to bring this up to investors because when you look at the moves we've seen, and we saw, Alibaba go as low as $75 and then rally as high as 112 basically in a matter of days. I mean, and that's one of the biggest companies in China as it is. I think it's important for investors to understand that when there was the panic last or 2 weeks ago, and it was all out panic, you thought about, was China going to side with Russia? Was the SEC going to delist these names? I mean, that's the type of environment that an investor that's looking to be aggressive and make a lot of money looks for, because that's where you see blood in the streets, the term blood in the streets, where stocks have just been annihilated and it's all out panic. And that's the buying opportunity that you look for. You don't want to buy into greed. You want to buy into fear. So again, good example of that. I do think, again, longer term, the Chinese names still look really attractive for upside.
Awesome. Once again, Gareth Soloway, thanks for joining us on GoldCore TV.
Thank you.
Thanks for watching. And if you enjoyed this video, check out these recent interviews, one with Rick Rule, ex-CEO of Sprott US Holdings, and this interview with Michael Pento of Pento Portfolio Strategies. You'll definitely enjoy those, so go there and watch them next. And remember, as always, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to GoldCore TV and hit the notification bell now. And if you want to learn more about how to buy, sell, and store physical gold and silver, log on to goldcore.com, your precious metals experts.